Hi, welcome to my channel. Thanks for being with me. Today, we are going to look at a outstandingly amazing investment in Canada. Probably the best government benefit for investments that there is in terms of their matching, and it's called the Registered Disability Savings Plan. Um, it's excessively powerful, and it is designed for long-term savings, retirement savings, and it helps Canadians with disability, uh, Canadians with disabilities and their family to save for the future. When I say and their families, when we do estate planning, if you have a child or if there's a member of the family who's disabled, estate planning has to encompass making sure that they're taken care of in the future years as well as in the present. And so that's what we're going to look at together. Uh, I've had many people set this up in years past, and it's a very common yet not always fully understood product. So I thought we'd do a video that way it could be shared so that people have a full explanation of the benefits of the product and how it works. So in terms of eligibility, you you have to be registered with the federal government for what they call a disability tax credit. So disability tax credit, it's a non-refundable tax credit. You have to apply for it. You need to have a medical person like your doctor also fill out the form. There's a process involved. If you think you qualify, you need help getting the application, just message me. I'll email you the application. So you need to have your social insurance number, need to be a resident of Canada, and you need to be under the age of 60. And so basically, you have to have the account set up prior to the end of the year you turn 59. Now, the RDSP, it has this really amazing matching program that the federal government will match, and they match it. It's called the Canada Disability Savings Grant. So it's the grant portion. You deposit money into the account, they throw extra money, either 100% more, 200% more, 300% more what you put in. It's so generous, and I'm going to show you the numbers there in a minute. But the matching component, you can only do that. The government will only match up until the year they turn 49. Reason being is design that they take out when they turn 60, like the RRSP. It's a registered retirement savings plan, really, but it's for disability, for someone with disability. They have a 10-year, because the matching, because the government is so generous, and because it's designed for retirement in the later years, they have a 10-year rule, which we're going to look at, has a bit of a clawback component to it if you take out money within 10 years of receiving either grant money or the bond portion, which we'll talk about in a minute. So it's income tested, meaning that what they do is if the beneficiary, so the person who has a disability, if they're a minor, then they match based on the age of the family. So mom and dad and stuff like that, the net income of the family. These are 2025 numbers. Okay. If the beneficiary, who's the disabled person who is registered for this program, if they are of the age of majority, and in Ontario that's 19, then it's based off of their income, okay, and for the grant portion. So basically, if the income is less than 110,000, 651 or less, the government will put 300% of your first $500 in a year. It's annual. So let's say I just put $100. Well, that 100 they're going to match, but they're going to put 300%. So 300% of 100 is $300. All of a sudden, You deposit 100, there's 400 there as a result of your 100. Okay. So they do that for the first 500. If you put another 1,000 or up to 1,000, they'll match 200% of that particular 1,000. So if I were to max out that year, the maximum would be $3,500 that the government would match. Okay. And it's split up between the first 500, then the next 1,000, and it ends up being that they'll give you 3,500, which is outstanding. Now, parents can contribute, grandma, grandpa, there's a lot of people who can contribute into this program. It's not just the beneficiary who can contribute. So if the income is more than 110,651, this is in that threshold changes from year to year. Okay. If that's the threshold, if you're over that, then they'll match 100%, and it'll be up to $1,000. So if you put 1,000, the government will add another 1,000. Okay. Which is really great stuff. Okay. I like this program a lot. So we looked at that grant portion, right? You see that? And now the government, the federal government, they'll also have the Canada Disability Savings Bond. So the bond portion, same rules. You don't contribute. You're not required to contribute, and the government will deposit the bonds if you qualify no later than the year you turn 48. So each year that you qualify, they'll put up to $1,000 depending on the income. So the adjusted family net income, and again, if the person's a minor, then it's kind of mom and dad's income kind of thing. If the beneficiary is age of majority in Ontario, that's 19. In your province, it may be different, but then this would be there. So a lot of people who are in this category, when they hit the age of majority, they are less than 37,487. So if that's the case, the federal government will deposit annually $1,000 of the bond, and it's an annual thing up to 20 years potentially, because there's a maximum of 20,000 that they'll deposit in that. So if their income is between 37,487 and 57,375, there's this pro rata portion of the 1,000, meaning that the bond amount decreases as your income increases, which is still amazing, right? Because you can get money. And then if you're more than that number there, the 57,000 number, there's no bond issued. And again, the government will max out at the 20,000 for this. So now, who is the plan holder? Now, the plan holder is basically the person who owns the account, and it doesn't have to be the person who has the disability. So the plan holder, they open the account and they manage the account. Okay. So if the beneficiary, which is the person with the disability who qualifies for the disability tax credit, if that person is an adult and they have the capacity to enter legally into a contract, they can be their own plan holder. Now, I've helped people set it up when they were minors and the parent was the plan holder. And then when they became age of majority, the beneficiary became age of majority, maybe they'd be able to do a legal contract, but the plan holder can choose to continue to maintain that status if they want. Okay. So now, if the beneficiary is a minor, then the plan holder is typically legal parent or guardian. If the adult beneficiary, so sometimes I've helped people set this up when they were adults. So if they lack a contractual capacity, right, then a legal representative could be the plan holder or parent or spouse, common law partner, or a qualified family member, right? They may be able to open the account on their behalf and manage it on their behalf. So consult with your financial professional before setting that up just to make sure. If you have questions, clarification, message me in the comments below. I'll be happy to help you out. Okay. So the federal government, this incentive, it's the benefit, this grant portion. So we know, which we talked about, that they'll put up to $3,500 per year, but they have a lifetime maximum of 70,000, which is amazing. Now you can deposit up to 200,000 and still be an exempt asset within the government benefit program. So in Ontario, it's the ODSP, the Ontario Disability Support Program. But they'll max out in terms of the grant deposits 70,000. The bond portion, they'll do up to $1,000 per year. Lifetime maximum is 20,000. So the government, if you max out everything and you're able to put 200,000 of deposit, plus the government puts 70, plus another 20 on the bond, all of that becomes part of an exempt asset that will not hinder the disabled person's government benefits, which is really wonderful. So the annual, no, there's no annual lifetime in terms of there's no annual contribution limit in terms of the what they can put in a month, but it is restricted to 200,000 lifetime. So the 200,000 deposit can happen over time. Now, if you set up, if the RDSP was set up in advance, and then in your will you stated that you wanted some of that money to be deposited into the RDSP to the max, then arrangements could be made that way. So in your will, if you want to leave your inheritance to a disabled person and you don't want them to lose their disability, you would want to set up a testamentary trust in the will so it could go in there, and then that would be exempt from their government benefits. You could also move 100,000 of the inheritance money into a segregated fund, and that would be an exempt asset in Ontario as well. So now this limit does not include the government grant, the bond, or the investment growth. So the 200,000 is what you deposit. The government grant portion or the bond portion, whatever they put in, it doesn't hurt your government benefits for your ODSP. And any growth, as the investment grows, that doesn't hurt your government benefits either. So the 10-year repayment rule. Now, when this first came out in 2009, when this program came out, Jim Flaherty, who was the finance minister for Stephen Harper, he's the one who introduced this, and really, really generous program. At the time, the 10-year rule, they used the language of clawback in the description. I don't see that description anymore, but that's in essence what it is. It's a clawback based on what the government put in if you pull it out within 10 years of the government giving their either bond or grant a portion. So it's a crucial rule to understand. Proportional repayment rule, also known as the 10-year rule. I like to call it the clawback because in my mind, that makes sense. I understand that. The RDSP is intended for long-term savings, and that's why this rule is in place. So if you make a withdrawal from the plan, or if the plan terminates for any reason, a portion of the grant and a portion of the bonds received in the last 10 years prior to the withdrawal must be repaid to the government. And works this way. So this is the rule. For every $1 withdrawn from the plan, $3 of grant and bonds paid which was put in the last 10 years must be repaid back to the federal government, up to the total amount of the grant and bonds paid in that period. So it's like a 3-for-1 exchange. And that's why they have that 49 year. So it's designed so that you start taking the money out in retirement when you hit 60. So if the government stops depositing their money by the end of the year, you turn 49. Well, that's a good 10 years, isn't it? So you then avoid this repayment rule. Okay. So the exceptions to this is this rule's in place until the 60 years old. The exception would be if the beneficiary has a shortened life expectancy. So to qualify, obviously, to be a medical person, like a doctor, would probably have a diagnosis, give a confirmation. You may have to get a note from the doctor to confirm this, and then would be submitted to the financial institute with the withdrawal to be exempt for that. So there's a process there. So if that applies to you, we can figure out the process and make sure that everything's okay with that. Okay. So in Ontario, each province has their own province disability support program. So the ODSP is for Ontario, and the RDSP is on the ODSP exempt asset list. So it's officially there in black and white, which is very reassuring for people when they set this up. So all the funds held in the RDSP are exempt as an asset. So it doesn't hurt them with their ODSP benefits, which I love, and it's just wonderful. So all contributions and withdrawals are also exempt from income charges. So impact on their benefits with the government, the Ontario government, from an income perspective. Okay. So let's look at the tax treatment. How is this treated from a tax perspective? So the contributions are not tax deductible like the RRSP. There's no tax deduction. So when you deposit, you're just depositing in, okay? And it's not taxable when withdrawn. So the contributions themselves, when you pull out the money that was contribution, that is not tax deduct. That's not taxable. Okay. Which is good. There is tax consequence, but not the money you put in it. Okay. So investment growth. So you put in money, the money grows. Any growth is taxable, but it's deferred. It's tax deferred while it's in the plan. So when you withdraw, if part of the withdrawal is actually considered growth, then that portion is going to be taxable. Now, on withdrawals, original contributions are tax-free, which we talked about, but the grant portion that the government puts in and the bond portion that the government puts in and investment earnings, which is the growth, those are taxable as income for the beneficiary. Now, that would be taxable income, so that portion may have some impact on benefits, but that's usually not a great amount because they don't normally pull it out in large volumes, right? So if they are able to take it systematically throughout retirement, then it's a small amount that impacts them. And that's it. So listen, if you need any assistance with the RDSP, if you have any questions or clarification, let me know. Would be happy to help you understand this better. And estate planning is very critical. So if you do have a a disabled person in your family and you're a breadwinner and you have assets that may pass to them, considering a Hanson trust may be advantageous. You would want to set that up as a testamentary trust in your will. And you want that done carefully just to protect them in the later years when maybe you're not around to help them. So listen, thanks for being with me. Have a wonderful day. We'll talk to you later.